Hello, welcome back to the continuing lecture in investment analysis. So our next question is, how good is capm in the real world? And as I've been mentioning this in passing so frequently, in conclusion, basically capm is a long-run equilibrium single-factor model. So in conclusion, in the short run, right, non-equilibrium real world, it doesn't work that well, okay? But again, once again, if you increase, the number of factors, in other words, number of explanatory variables, right? It doesn't always, increase the. I mean, it doesn't always increase the accuracy of the forecast or the projection, or or the accuracy in the explained variable, right? Usually it does, with more factors. Even by little, it would. Again, but then the total F statistic matters, and individual t values may be spurious, meaning just unreliable and frivolous, right? But however, since it is long-run equilibrium model, right? They have over the years, they've come up with some multi-factor versions of capm, right? Because capm was first published by Sharpe, the guy who came up with the Sharpe ratio, in Journal of Finance in 1964. So it spanned already like almost 60 years since then, right? 6 decades. Obviously, there must have been some improvements, but still, the fact that even 6 decades later, all the finance textbooks basically all teach capm, because it's like the reasoning and the logical foundation of capm is indisputable. Its simplicity in its explaining power is clearly the foundation of any model, any sophisticated or improved model upon it. You can't. So over the years, then was there critiques? Were there critiques of capm? Yes, there has been critiques. There have been critiques of capm. But eventually, capm, survived all, those critiques, and even outlived all and still outlived all its competitive models, and still goes strong as the fundamental model, right? So anyway, early test by Black, Jensen and Scholes, Black as in trainer Black model, Scholes, Myron Scholes, Black and Scholes actually won a Nobel Prize in economics in like 1996, 95 or 96, for their contribution in option pricing model, actually. In 1972, these people, these scholars, tested, and Eugene Fama and Kenneth French are also, strong household names in finance. Fama and Macbeth in 73 were only partially supportive of CAPM. Average returns were higher for higher beta portfolios, but reward for beta risk was less than predicted by a simple version of CAPM. Maybe look, to put it this way, let's say if beta is 1.5, then what does that mean? The reward, in other words, the excess return on the stock I, must be at least 1.5, or on average 1.5 times the market risk premium. But what they found empirically at the time was that it wasn't less than 1.5. Okay, that's and then in 1977, Roll, there were two people, Roll and Ross, they all famous critiques of CAPM. In Roll in 1977 wrote in Critique of Capital Asset Pricing Test, argued that since true market portfolio can never be observed, CAPM is necessarily untestable. Some tests suggest that error introduced by using a broad market index as proxy for true unobserved market portfolio is perhaps not the greatest problem. It's not. It's still, very theoretical. Theoretical attack, because of course, but we have established why it is, good enough to use index, right? Market index as the broad proxy for broad market portfolio, right? And Eugene Fama and Kenneth French in 1992 claimed that, in contradiction to CAPM, certain characteristics of firm, such as size and ratio of book value to market value, were far more useful in predicting future returns than beta. Apparently, beta does not tell the whole story of risk. There exist risk factors that affect returns beyond beta's one-dimensional measurement of the market sensitivity. Well, beta, again, beta is only the coefficient, right, of the explanatory variable. I mean, if you have multi-factor model, the beta we're talking about here is only the beta of the market portfolio. I mean, if you can identify other uh, systematic factors, then there can be beta 1, beta 2, beta 3, right? And beta n. So, and then John Campbell. John Campbell is also very, household name, a famous, renowned John Campbell at Harvard. As a grad doctoral student, uh, I had his textbook, Campbell. John Campbell and Tuomo Volti. Now, I I gave up on pronouncing his name. Split beta into two versions, two types of beta. Value of a company depends on expected profit and interest rate to discount those profits. So the change in share prices stem from change in one of these factors. Therefore, beta to gauge shares response to change in profits, and beta to pick up effects of change in interest rate. So we'll have to use two. That means two factor models, two betas. Separate cash flow versus interest rate betas helps better explain performance of small and value companies. Value companies means, of course, when we say value stocks, they are stocks that have higher earnings power for its price, right? Shares of such companies are more sensitive than average average shares, right? Average companies to news about profits, in part because they are bets on future growth. Shares with high profit earning ratios, high P ratios, vary more with discount rate. Yes, of course. High P ratio means what? The price, these are expensive stocks for its earnings. Obviously, as discount rate changes or as discount rate goes up, if the investors would the investors would feel more, that feel their position in these stocks to be more, risky because they are more speculative stocks, right? Because high price for its earnings power means, speculative stocks. So they would move their money, right? When interest rate goes up, right? To, lower price earnings ratio stocks or to treasury, right? And Amihud and Mendelssohn in 1986 also critiqued that liquidity is another risk factor, something that is not well priced in or incorporated into the model is the liquidity. Accurately measuring the liquidity and the liquidity premium commensurate with illiquidity, right, must be incorporated into portfolio management as well. And in 1996, Jagannathan and Wang also came up with the argument that more exclusive proxy for market than S&P 500 is needed, specifically an index that includes human capital and allowing for fact that beta changes over time. So beta's explanatory power of security returns is considerably enhanced. I mean, in their in their model. Just check back. Oh. Okay, I'm gonna have to edit something here. Edit. Where's edit? Edit. So, yeah, I mean, what they are saying is basically, if we use beta that allows for all those factors, then uh, uh, explanatory power of beta will, be considerably enhanced, right? So it should be what it is, but hey, just yeah. Sometimes, when I write, when I make, slides, um, the tense of the verb is uh, very important because the wrong tense would make wrong impression or give wrong interpretation. Um, yeah, so that's the part that I needed to edit and revise. And let me really have something to really edit. Oh, now, so well, obviously, after all these, critiques, I mean, when they critique something, they should come up with some uh, alternatives or solution. So, I mean, it's easy to critique, I mean, critiquing, you have to. I'm not saying uh, it's. I'm not saying that it's just absolutely easy. I mean, to critique, it shouldn't be baseless, right? It must be founded on something. You have to have grounds for your criticism, right? Um, in the academia, there are, in journals, uh, there are lots of papers, that critique mainstream model or theory. And lots of times, yeah, they critique with, some uh, uh, basis, right? Uh, they have their own rationale, uh, justified, rationale for critiquing. But then, not too many critical papers, not to uh, actually, uh, offer a solution, right? Uh, so, but these people came up with alternative models, after as a result of the critique. So obviously, as I said, multi-factor models came out. Uh, multi Because they all were claiming that market beta alone is not enough. There must be other systematic factors. So, for example, so let's say two index portfolio. Let's assume two index or two factor, two macroeconomic factors or two systematic factors. Um, One factor can be, well, this is a market, index, of course. Second one is treasury bond. Okay, treasury bond, right? Uh, Treasury bill is already, treasury bill is, risk-free return. So it's not even, and risk-free return will be included in the alpha, right? Long-term, what determines the course of the economy is the long-term interest rate. Isn't that right? I mean, you all understand. Basically, that's what the Federal Reserve does, right? Not only uh, in the short run, right? Um, the Treasury bill rate is basically benchmark for short-term financial market. But for long-term financial market and for long-term macroeconomic uh, policy, right? A monetary policy, 10-year Treasury note or a Treasury bond, with longer term maturity, uh, is the key indicator or key factor of the macroeconomy. So it makes a good sense. It makes quite a good sense to use Treasury bond as another uh, explanatory variable or another index. That would be a good example. So, and actually, uh, Robert Burton, another famous economist, he also won Nobel uh, economics. I think in 1980 something, or early 1990s. I forgot. But 1973 came up with this, exactly that model. So, of course, this is excess return on the market index, and this is excess return on treasury bond, so risk premiums, right? And if you move this to the other side, it will be exactly the index model, right? And how well did this model, how well did it fare? We're going to actually take a look at the regression result later on. But for now, let me introduce three-factor model, right? So Fama-French three-factor model came out in 1996. That's Eugene Fama and Kenneth French. And it's also, of course, index model, right? This is market index. And what is this? High, low, right? High, low, H, L would mean high, low. S and B, small, large, small, minus big. Okay. HML is high minus low. SMB is small minus big. So SMB, small minus big, is called size premium. It's the difference in returns between small and large firms. Usually small firms have higher return because small firms are growth firms. Generally, small firms grow at a faster rate. Large firms generally don't grow that much, right? That means small firms have, more volatility. Goes without saying. High minus low is basically book value to market, book value to market value premium, right? Book value to market. So in other words, flip it. If you flip it, we've been, talking about this in stock valuation, market price to book value ratio. I mean, a company with, high market price compared to its book value per share, what does that mean? Such a company is generally overvalued, and it's like a high P ratio. I mean, strong demand for such a stock for its actual book value, right? Which also is another indicator that this is a speculative stock, right? So if you flip that, market price to book value ratio, then it's B over M, right? Book value to market price ratio. And obviously, the lower the number, the higher the number, it's, less speculative and more earnings power, right? The lower the number, more speculative, right? Lower earnings power, right? So, so three aspects of successful. Then if the model is successfully specified, right? Model specification is successful. Obviously, adjusted R squared, the goodness of fit, should increase. Goodness of fit should increase, and the residual should be lower. In other words, error terms. It's called. How do you measure the if model is more precise and accurate? It's called. You use a statistic or metric called root mean square of errors. Root mean square of errors. Squared errors, right? We understand the larger the squared errors, which is sum of squares, right? Sum of squares minus total sum of square, right? Total sum of square terms minus explained sum of squares, right? Total sum of square means, basically variance minus explained sum of squares is the systematic part of the variance, right? So if total sum of squares minus explained sum of squares is, unexplained sum of squares or residual sum of squares, residual, or error sum of squares, error, right? Now think about it. The smaller the error sum of squares, the higher that means the higher the better the predictive power, right? Um, the better the model, the better the accuracy, the higher the accuracy. Make sense? So think about it. Root means squared. Root means mean of the squared errors, mean of the squared errors, right? And root means it's square terms, so take the square root, and the smaller the number, the better the model, right? And the smaller value of alpha. Now think about it. You understand, because we're using an index model, risk premium over risk premium. There's no if the model is accurate, right? Uh, the vertical intercept should be smaller, right? The smaller the better. Which means that everything falls neatly on the. If there is no alpha, then means and squared error terms are um, 0. And that means everything, all the plots fall nicely, neatly on the security market line. I mean, the security characteristic line, right? Then that's a like a perfect forecasting model, right? Now, economic interpretation of SMB return. Return from a long position in small stocks financed with a short position in large stocks. Now, I mean, this is just one way. So what does that mean? If you short sell, right? If you short sell large stocks, right, and with the proceeds you invest in small cap stocks, this is a kind of arbitrage strategy, right? Arbitrage meaning you don't use any of your money, right? There's no net investment. Wow. And if this beta is if this beta is greater than 1, I mean not necessarily beta, but uh, but if this is positive, not just if this is positive, right? Your arbitrage strategy is good. It's working, right? And can rather be interpreted as a side bets on whether one type of stock will beat another, right? Whether small ones beat the large, small cap stocks beats the large ones. Okay. Now, we need to talk. We need to discuss, high, high minus low book value to market price factor. But we have run out of time, so we'll discuss this in the next video. Okay, and so I will see you guys in the next session. Okay, thank you for watching. Stop recording.